In the standard methodology for retail and algorithmic technical trading, practitioners often rely on confluence, the simultaneous alignment of multiple indicators before entering a trade. The relative strength index hits an oversold threshold, the stochastic crosses upward, and the MACD flips positive. These panels snap into glowing alignment. A trader looking at this chart typically assumes that 3 tools agreeing provides 3 times the statistical evidence for a move. This reaction is driven by a psychological need for certainty. In an environment governed by chance, we often fall into the illusion of validity, placing undue faith in the accuracy of our judgments when the data seems dense and precise. But this agreement is frequently a mathematical illusion caused by multicollinearity. True confirmation cannot come from recursive data. This recursive stacking often creates a feedback loop, where the trader is simply observing the same data reflected back through different formulas. In statistical modeling, multicollinearity is the unknowing, repeated use of the exact same underlying information in a predictive model. Momentum oscillators are deterministic transformations of the exact same rolling windows of open, high, low, close, and volume data. Because these formulas share the same price inputs, their outputs are mathematically tethered to one another. Their agreement is a mechanical outcome rather than independent confirmation. Quantitative analysts use the variance inflation factor, or VIF, to diagnose this overlap. A high VIF indicates that redundant variables are distorting the model and making it unstable. Recent deep learning research highlights how these redundant configurations affect actual forecasting performance. This performance heat map shows that feeding an AI model all indicators actually degraded its performance. Note the stark red shading. Prediction error increased by 34.6% compared to using raw price data alone. The researchers found that this failure stems from 3 factors. First, accumulated redundancy, the compounding of measurement noise, and the dilution of capacity. Stacking these indicators inflates standard errors, making it highly unlikely that the trading system will generalize to unseen market data. Genuine confirmation requires an orthogonal vector, an independent exogenous data source that doesn't rely on the same price series. The Pearson correlation coefficient provides the mathematical tool needed to build this vertical confirmation layer. This metric quantifies how 2 distinct assets move in relation to one another over a rolling window, mapped on a scale from negative to positive 1. Values above positive 0.7 indicate a strong positive relationship, while values below negative 0.7 signal a strong inverse relationship. This fundamental shift changes the trader's primary question. Instead of checking if redundant oscillators agree, we look to see if the market is participating. For example, a stochastic buy signal on the US USD can be filtered by checking its 30-day correlation against the GBP USD. Looking outward at intermarket relationships helps filter out localized noise and validates true market momentum. Correlation is dynamic, serving as a tool to identify structural market regimes as they evolve. This involves tracking a short-term correlation window, like 20 days, against a long-term window of 250 days for related assets. When short-term correlation crosses above the long-term average, the sector moves in unison, a structural trend. Here, momentum strategies thrive as the macro tide lifts all components. Conversely, when short-term correlation plunges below the long-term average, assets decouple into a mean reversion phase. In this decoupling phase, traders must filter trend signals aggressively or switch to reversal strategies. Correlation serves as a gatekeeper that mathematically defines the specific category of tools suited for the current regime. However, even correlation is subject to the illusion of data validity. High correlation measures short-term linear co-movement, but it does not imply a permanent or causal bond. Financial markets are inherently non-stationary. Their underlying statistical properties constantly evolve over time, meaning that previously stable, trusted relationships can suddenly and violently collapse. This is why we differentiate correlation from co-integration. Co-integration identifies a long-term structural tether, while correlation is used as a tactical filter. During liquidity crises or geopolitical shocks, a contagion effect often drives the correlation of almost all assets toward a positive 1.0. Correlation data reflects how assets moved together in the past, it cannot predict the exact moment a structural market break will render those relationships obsolete. Modern decision-making requires the removal of internal redundancy. Discard indicators that share a high variance inflation factor. Cross-asset correlation should function as a structural gatekeeper that validates broader market participation. This leads to the 0.7 gatekeeper rule. Execute technical signals only when they are confirmed by an exogenous asset correlation above 0.7. If that correlation threshold breaks, the protocol mandates a reduction in position size or pausing the strategy entirely. Maintaining an edge requires the rigorous filtering of redundant noise and constant adaptation to evolving market structures.